Hey guys, what's going on? Today is Wednesday, and sorry I took a break for 2 days. I was getting ready for some future videos, so I hope you'll forgive me. But anyways, all that aside, today we're going to be talking about earnings per share, EPS, which is a very key fundamental indicator of a company's health. So let's get into it. So first of all, what is the EPS? What is the earnings per share of a company? What does it mean? So the EPS, or the earnings per share of a company, is sort of like a part of the report card of a company. It basically shows, as you can see in this graphic here, the total earnings or profits of the company divided by the total number of shares issued out by the company. And it is a very important indicator of the health of a company and its kind of long-term growth and profitability. And so higher EPS is a good sign of a company's health, as that means that they're making more profit for the same number of shares. So if two companies had the same amount of shares issued out and one was making higher profits, they would therefore have a higher EPS. So a higher EPS is good. But I will get into it later how a higher EPS can kind of be like fraudulent, or there can be a variety of factors that can influence the way an EPS is looked without profits being actually greater. But that'll be later in the video. So we calculate EPS like so. As you can see, it is the net income of the company. So all the money that they have after taxes and all that stuff, minus preferred dividends. So dividends is just the money that is already paid out to investors, so that doesn't count. And all that is divided by the common stock of the company. So the stock that is issued out by the company for investors and traders to buy. And that is how you calculate the basic EPS. So, and I specify and emphasize basic EPS because there are different types of EPS, and I'll talk about a different type of EPS called the diluted EPS later in this video. So you can see an example, a very easy example of how the EPS is calculated. Say, for example, a company is making $10 billion net income. So after all the taxes and all other stuff, all the expenses, and then they have to pay out $2 billion in dividends to their maybe preferred investors, right? So preferred dividends are gone, or preferred stock, I'm sorry. And then they have 4 billion shares outstanding in total. So 10 minus 2 is 8 billion. 8 billion divided by 4 billion is $2, and that is their earnings per share. And then there's also, I want to bring this up because it is also an important indicator of the health of a company uh, in a whole entire year. So, as you can see here, EPS is reported to the public 4 times every year. So, there's Q1 just stands for first quarter. So, first quarter through fourth quarter. And so most companies report their EPS in line with the calendar year. So the third month, which is March, sixth month, June, ninth month, September, and 12th month, December. But they can also report them based on their own fiscal calendars, and lots of companies have their own fiscal calendars that they can report it to. But most, I feel like, report it based on the calendar year. So you can also see here in my example that there it can be a negative EPS. And this is possible for companies in decline or for companies who heavily invest in themselves and have a lot of debt, and as a result don't have much net income left over. And actually have negative income. So it's negative. And a good example was Tesla. I remember, Tesla was investing heavily in itself, was making a lot of new products and stuff like that, and so they often had a negative EPS, and many and I'll actually get into a kind of nice little story about the negative EPS for Tesla later in the story. But as you can see, the annual earnings per share is just the 4 quarters of the year's quarterly EPS added together. So 1.14, 2.15, negative 1.20, and 1.01 equals $3.10. And that is their annual earnings per share. Simple enough. And so this is kind of where my funny story about Tesla comes in, where we are talking about estimates and surprises. So before each earnings report is actually announced to the public, analysts will often speculate on the company's earnings, and this is called the consensus estimate. And these earnings estimates are based on a variety of factors, such as forecasting models that these analysts use, the company fundamentals, such as and like management of the company, like new CEOs, old CEOs, past trends. All that stuff is kind of uh, taken into account when these analysts are trying to predict what the future quarterly earning is going to be. And so the difference between the actual earnings, which is what is actually reported, and the estimates are called earning surprises. And they can be positive or negative. And the differences in these earning surprises can have very heavy effects on the stock price, as you will see in my next slide. But first of all, I just want to talk about this. You can see here that analysts estimate is going to be negative zero point 0.7. And yeah, so if analysts believe that the company may be investing heavily in itself, they may actually estimate that they will have a negative earnings. So, but even if the negative earning is higher than what the actual earning is actually higher, but still negative than the estimate, then you're still going to have a positive earning surprise, as you will see in my next graph. So this chart is actually for the stock shop, which is Shopify. And you'll see here the EPS effect. So as you can see, the estimated earnings for that quarterly earnings was 0.053 cents, but it was actually 0.14. So you can see here, when immediately after it was announced, there was a huge surge in the stock price because the actual earnings were able to beat the estimated earnings. So many stock investors often don't like to, oh well, if they're trading on a short term, don't like to hold during these earnings reports because they can swing either way. They can either swing below what was estimated, so that means there's going to be a heavy drop in the price, or it can go above, and you can see, as you can see in this graph, is going to be a very high increase in the price. So many traders don't want to go through that risk, so they often exit their positions before earnings reports to make sure they can miss this very volatile period. And so, as I talked about before in a previous slide, I want to talk about basic versus diluted EPS. And so, basic EPS is just, as you can see, it's earnings per share, earnings per uh, outstanding share. Basically, all the shares, the current shares that are out on the market to buy. So earnings over the current shares on the market out to buy. But diluted EPS is earnings per convertible shares, and it is earnings divided by all possible things that could be converted into a share, like debt could be converted into shares, you know, equity, as you can see here, they can all be converted into shares, and those are all counted. So it was like all possible methods, all possible, I guess, ways of making a share, if you understand that. So you can see in the formulas how they're different. The basic EPS is just net income minus preferred dividend divided by outstanding shares. Simple enough. But the diluted EPS takes into account all the convertible securities. So it takes in the net income plus the preferred dividend plus debt interest, and then divided by all convertible securities plus the outstanding shares. So at the end of the day, the question is, why is the EPS so important? Why do traders look at it? Why do they use it as an indicator for whether or not a company is good to invest in? Well, first of all, it evaluates the company's management. It shows the management's priorities and the management's ability to make a profit. Because at the end of the day, a share is a slice of the company. And if they can't make money, then you are also sharing their profits or sharing their losses. So the EPS is good because it tells you how much money the company is making for you as an investor. It is also a good method of comparison. It shows a difference in growth between companies because you're dividing it by the total number of shares that each company has. It is a standard level of comparison between companies, and it shows difference in growth, it shows difference in decline, all that kind of stuff. And it shows the company's future value and profitability. If it's a high EPS, then that's a good sign that it'll continue to be profitable, and that its value will thereby increase in the future as well. And it also indicates dividend payouts. If its EPS is very high, then it's very likely that dividends will soon be paid out. So that's all I have for EPS today. I really hope that you understood what the EPS is, why it's important, and the difference between diluted and basic EPS. I also talked about the estimates and surprises. So, yeah, be careful with those. Definitely don't want to hold through them. Well, at least that's my personal opinion about earnings estimates and surprises. But anyways, if you like this video, please leave a like. And also, if you like the videos that I make on my channel, then please subscribe. And so that's it for me today. Thanks, y'all. Bye.